Hi students. So in this presentation we are going to discuss about budget methodologies. In the previous video we have discussed about concepts of budgeting, and here it is going to be different methods of preparing a budget. So different budgets. So in an organization normally you have to prepare a number of budgets. So this budget can be a sales budget, or it can be a production budget, it can be your material budget, it can be your labor budget, you have sales expenses budget, you have marketing expenses budget. So you will have a number of budgets that need to be prepared in an organization, and some of them it need to be prepared in a specific order. For example, if you know how many units you are going to sell for the coming year, then your production plan will be more efficient, right? You know how many units you are going to sell, so you know how many units I have to produce. So first we have to prepare a sales budget, then only you can prepare a production budget. So here we can see sales budget is the first budget normally prepared, and cash budget is the last budget to be prepared. Okay, we will get into the details of cash budget and all later. So we will move on to operating budget. So in the operating budget, you are actually emphasizing on obtaining and using the current resources. So how you are going to allocate and use the current resources. Or we can say all these items you can find in operating budget is related to income statement. You can see sales budget, production budget, material, labor, manufacturing overhead budget, finished goods inventory budget, and finally cost of goods sold budget, and also non-manufacturing budget. Everything is coming under income statement, right? All these line items are coming under an income statement. So, and this is what actually operating budget is. It is related to the operations of the company. So how you are going to utilize your shorter resources in a short period. And once you prepare uh, all this, you will prepare a pro forma income statement, or we can call it as a forecasted income statement. So what is going to be your net income by end of the year, considering all the above said budgets? So it is going to be a forecasted income statement. Then you may have also financial budget. So here emphasis is going to be on the funds needed to purchase operating assets and how you are going to use it. So in this you have again number of budgets. You have capital budget. So this is normally prepared before operating budget is begun. Suppose if you want to buy a new plant and machinery, you have to decide whether to buy it or not. For that we will use capital budget. Then we will have projected cash disbursement schedule and projected cash collection schedule. So how much you are going to pay out this year, and how much you are going to collect during the period, and how much you will have your cash. So uh, is the cash is going to be in a surplus situation, or you are going to have deficit? So when you have a cash budget which is forecasted, and we know how much cash I am going to have, then based on that you can plan for the future. Maybe you will approach to a bank to get facilities, or maybe if you will have more money with you as a surplus, you will plan about how I can invest this money somewhere else. Okay, so all this will be coming under financial budget, and once you prepare all these things, you can prepare a balance sheet, which is pro forma balance sheet. Again, it is a forecasted balance sheet and also a forecasted cash flows. So based on all the information you are getting from those budgets, you can prepare a pro forma balance sheet. So how much asset you are going to have by end of the period, or how much liabilities you are going to have, and how much cash you are going to have in terms of operating, investing, and financing activities. Okay, so this is what actually financial budget is. So we can say all these budgets are related to your balance sheet, and operating budget is actually related to your income statement. So our first budget is going to be sales budget, and this is the budget that must be completed first. Why? Because everything else company will do during the year is based on how many units they expect to sell. So when you have a sales budget, you know how many units you should produce. And when you know the production, how many units you need to be produced, you can plan for how much material I need and how much labors I have to do, I have to, procure, and what will be my overheads. All these are related to how many units you are going to sell. So this is the most important budget. And also this is establishing target for sales personnel. So every sales manager will have a target. So based on the budget, we are going to sell 1 million units for of X product, and the sales manager know that this is what my target is. If I am not able to reach this budget on monthly basis, then I have to make some changes. But how you will prepare a sales budget? It is based on some sales forecast, right? Because you are talking about the future. But your future is sometimes getting information from the past, and you are doing a forecasting. So this forecast will consider your consumers. How is going to be your consumers' behavior in the coming year or coming period? And how is the competition going to be? How is the rivalry in the market in the coming year? And how the economy is going to do? Are you is the economy is going to be in a boom, or economy is going to be in a bad situation? So based on this, your sales may differ. And past sales levels and trends. So what was the sales happening for the coming few past years, and how was the trend, and are you expecting the same trend to be repeated in the future? And also, how much you are going to spend on advertising and promotions? Maybe the more you spend, your sales are going to be more. And also, credit and pricing policies. Are you going to give credit facilities to all the customers, and are you going to be lenient towards providing credit? Then maybe your sales will increase. But if you are rigid on providing credit facilities to your customer, maybe your sales will be less. So we have to consider all these things before we prepare a sales budget, or we can say we have to consider all these things to have a sales forecast in our hand. And these are the role of sales budget in annual profit plan. So annual profit plan, we can say this is the budget for the complete year. And what's the role of sales budget in it? Actually, sales budget is giving you a foundation, and this is the cornerstone for the entire profit plan. So as we said, first we have to know how many you are going to sell. Rest everything is going to be based on this. So this is a foundation. Sales budget is going to be a foundation in the annual profit plan. And you are going to have a revenue projection for the period, correct? So this is going to estimate how much you are going to sell, your sales revenue. So based on this, you can get guidelines for your financial targets. Like this much I am going to sell and I am going to have this much profit. So I have what I am going to do in terms of investment next year. So you can have a plan like that. Also cost planning. So when you know what is your sales in units is going to be, then that is going to impact your cost of goods sold also, right? So I'm going to sell 100,000 units, so I will have uh, double X uh, of cost of goods sold. So when you are going to sell more, your cost of goods sold is going to be more. So cost planning can be done. Profitability analysis. This forms a basis for calculating gross profit and net profit margins. So when you know the total sales, how much it is going to be, also you can find out how much is going to be my gross margin and my profit margin. Decision making. Guide resource allocation and strategic planning based on sales forecast. So you know how many I am going to sell. So you will be able to allocate your resources efficiently. Do I have to get more of the labors based on the sales what I am going to have, or I have to cut down in my labor cost, or how much I have to purchase in terms of materials. All these things you can know if you have a plan ahead. Also, performance tracking allows comparison of actual performance against sales projections for adjustment. So you have a plan in front of you, right? You have a target need to be achieved. So in any certain point of time, you can check if the target is being achieved or not. If it is not achieved, you will investigate about it and try to find out why it is not achieved. Okay, so these are the roles of sales budget in an annual profit plan. So here we have an example of how you will prepare a sales budget. So here sales budget that displays projected sales in units and the projected sales return. So you can see here you have first quarter, second quarter, third quarter, fourth quarter, and this is for the complete period. So imagine I am going to sell 15,000 units in the first quarter, second quarter 5,000, third quarter 10,000, fourth quarter 20, and total 50,000 I am going to sell, and per unit cost is going to be $12. So you will get 180,000 sales in the first quarter, 60 in the second quarter, 120 in the third, and 240 in the fourth. Why? We are incorporating the seasonal pattern in the sales. So normally we will have more sales in the fourth quarter and in the first quarter. So this way you know how much sales we are going to make. So we are going to sell 600,000 worth of goods, or we can say our sale is going to be 600,000. Now once the sales budget is prepared, the second budget is going to be the production budget. So after the sales budget is completed, the company can prepare a production budget. So without you know how many you are going to sell, you cannot prepare a production budget, right? How many I have to produce? For that, I should know how many is going to be sold. And this budget is based on, again, what is the expected level of sales? How many units you are expected to sell? And expected level of inventory to be maintained. Okay, I will sell 1 million units during the period, but I have to have at least 100,000 units as an ending inventory. So totally I have to make 1,100,000. Then you will check how many units I have now. Say I have 50,000 with me in the store. So I have to make only 1 million 50,000 only. So we have to know how many you are going to sell and what is the expected level of inventory to be maintained. And are you going to outsource any production? For example, we are going to buy from outside maybe 250,000 units. We are not going to make it internally. So how many I have to make internally? Now it is going to be only 800,000 units because 250,000 we are not going to make, we are going to buy from outside. So this budget also needs to include when during the year units will be produced. So that's what we'll be seeing here. The first quarter, how many units you have to produce. Second quarter, third quarter, fourth quarter. So when we know when these need to be produced, that will help us to allocate the resources more efficiently. We don't have to buy all the material in the beginning itself, right? Because we know when you need more materials and when you need less materials. So you can efficiently handle your fund. Okay, so this is an example of production budget. So as I said, you will check how many units of sales is going to happen in the coming period, plus what is the ending finished goods inventory uh, required by end of the period. So this is what actually I have to produce. Total units required is sales in units plus desired ending inventory. But now we will check, okay, I need this many units. In our example, I need 1,100,000 units. So I will go and check how many are there in my store now. This is the beginning finished goods inventory. So from this, we will minus the beginning finished goods inventory. Then we will get how many units need to be produced. So sales in units plus finished goods minus beginning finished goods is going to give you how many units you need to be produced. So we know that sales in the first quarter is 15,000. That is we are getting from the previous slide. From here 15,000 is our first quarter sales. So that we will consider. And also by end of this quarter we need at least 500 units in the inventory. Okay, so 15,500 I need in the first quarter. But I have already 1,500, so I don't have to produce 15,500. So I will produce only 14,000. So 15,500 minus 1,500, you will get 14,000. So in the second quarter again, I need 5,000 units need to be produced, and I need normally 10 percentage of next quarter sales as the ending inventory. You can see here this is also 10 percentage of next quarter sale. So total what I need is 6,000 units. So we are keeping a buffer for the next quarter also. So total I have to produce 6,000 units. So how many units were there in the beginning? So that what was the finished goods for the last quarter? That is going to be your opening, right? So that we will minus, then we have to produce 5,500 for second unit. So this will repeat for third and fourth quarters also. Then you will know finally what will be my uh, production in terms of units. So 50,000 units we need to produce. So once we prepared our sales budget, we prepared a production budget. Now, if you are not a manufacturing company, for example, you are a retailer, so you will not have a manufacturing or you will not have a production budget. Instead, you will have a purchase budget. So how many units need to be purchased? That is based on the same formula we have seen here. Sales in unit plus ending finished goods minus opening finished goods. So that is going to be the number of units I need to purchase this period. Other budget what we have to prepare after the production is, so production budget is set. The company can create a number of other budgets that are based on the level of production. So how many units you are going to produce, based on that you will determine how much material I need, how much labor cost is required, what will be my overhead based on the production, and what will be the budget of ending inventory, and finally what will be the cost of the goods sold. So based on this, based on the production budget, you can prepare all these things, and all these are interrelated. All these budgets are interrelated, so a change in one will impact a change in another budget also. So we are discussing about the interrelationship of production, direct material and direct labor budgets. We can see here production budget. This outline quantity of products needed to meet sales demand and also inventory levels that needed to be kept. So how many units you have to sell and how many units should be there in the ending inventory. So that will be outlined in a production budget. Now estimates of quantity and cost of material required will be given in direct material budget, right? How many units of material we need and what will be the cost of that. But this is based on what? This is based on production budget, right? It is based on the production. You will decide how much material you are going to have. Then you have direct labor budget. Estimates quantity and cost of labor needed. How many hours of direct labor I need? Again, this is decided based on what? Based on your production volume. So all these are interrelated. So we found how many units we need to produce in the previous presentation. Based on that, we have to prepare a direct material budget. So to prepare direct material budget, we have to see first how much material required for the period. First we will see that how much material required. How you will know that? First you will take raw material required for production. How many units needed to make your production for the period, to complete the production for the period, and how many units you need as a buffer in your ending inventory. How many units of materials. So this if you add together, we will know total material required. From that we will minus what is the beginning inventory you have for the raw material. So if you minus that, we will have an understanding about how much raw material need to be purchased. So first again, same like production budget, first we will see how much material needed for to complete the production and what is the desired ending inventory. If you add that together, you will get raw material required for the period. From that minus the beginning inventory of raw material, then you will get exactly how many units I have to purchase for the period. So that is what's shown here. Based on our production budget, we have to produce 14,000 units, correct? So we are getting that from this budget. 14,000 units we need to produce, and required per unit is like 1.5 yards of material you need. Okay, per unit. So 14,000 units, you need 21,000 yards of material, and also I need 10 percentage of the second quarter requirement now. 10 percentage of second quarter. So total what I need is 21,825. Then I will check how many units I have now. I have 2,100 units. That is the beginning inventory. If you minus, I have to purchase 19,725, and every unit will cost you $2. So you will know how much I will have to pay for the material in the first quarter. And that is going to repeat for all the quarters. Second year, as per the production, we need 5,500 units to be produced, and every unit need 1.5 yards of material. So what you need is 8,250. So already we have 825, so that we will minus later. And also you need ending inventory of the coming quarter, like 10% of the coming quarter in the ending inventory. So what I need total is 9,900, and I have now 825. So 9,075 I need to purchase. Multiplied with 2, my purchasing cost is going to be 18,150. So this is how you will prepare a direct material budget. Then you will prepare direct labor budget. This shows the number of hours and the cost of direct labor. Again, this is based on what? Based on your production. I need to produce 14,000 units, and every unit required 0.2 hours. So that means I need 2,800 hours of production, and per hour I am paying $10. So $28,000 I need in terms of labor cost, and that will repeat for all the quarters, and total $100,000 I need in terms of labor cost. So labor cost we need 100,000, and material we need 150,000. So both this we got now. Now it is going to be overhead budget. So overhead budget informs production budget by providing cost to be spread across production units. So how much you will have your overheads. We discussed about overhead in section D, and how you are going to spread this overhead cost over the units you are going to produce. So overhead budget informs production budget by providing cost to be spread across the production units. So your production budget is getting information from overhead budget. What is going to be my overhead for the coming period? And based on that information, production volume influences the allocation. Okay, this is going to be the overhead budget, and now how I am going to uh, allocate the overhead? That is based on how many units you are going to produce, right? So both these budgets are related. So accurate overhead budget ensure proper allocation of cost in production budget. So we can say we are anticipating $100,000 of manufacturing overhead, and this is the overhead I need to allocate to 25,000 units I am going to produce. So these are actually complementing each other. This 100,000 will be this $100,000 of overhead that is going to be spread between 25,000 units. So we need to know how many units you are going to produce and how much is going to be the overhead. So again, both of these budgets are also interrelated. So this way you will prepare an overhead budget. This shows the cost of overhead expected to be incurred in the production process during the budget period. So how much overhead is expected to be incurred? And this overhead can be based on unit level. For example, indirect material. So this cost is going to be based on every unit. Or maybe some costs are maybe based on batch level. For every batch, how much it is going to cost. For example, setup cost, machine setup, or material handling cost. This will be calculated for every batch. For example, you are in a t-shirt making company, you have a batch of say 100,000 units of a small shirt that need to be produced. After that, you have to change your machine setup. So that cost is going to happen only for that batch, only one time for a batch. So that cost is going to be batch level. Some cost it is going to be based on product level. For example, we are redesigning our product. So it is going to happen only once in the life of the product. So these expenses are going to be based on product level, and some are based on facility and general operation level, like supervisor's salary, insurance, property taxes, maintenance, utility, depreciation. All this it is going to be based on the facility and general operation level. So again, you will have different amount. So you got here total overhead 51,500, and maybe you will minus depreciation from that, so you will know how much in terms of cash outlay I'll be having. So total cash disbursement for overhead is going to be 36,500. Again, this is going to repeat for all the quarters, and finally you will have actually 140,000 in terms of manufacturing overhead budget. So if you have all these things, you can prepare a schedule for cost of goods sold, cost of goods manufactured and sold. The formula for this we already studied in section D. So here we can see my raw material opening is 4,200, and what purchased during the period is 150,000. So what is available for sale or available for use? 154,200, and I have already an opening balance of 4,200 with me. So direct material used is going to be $150,000. So same formulas we have done in section D. Then we will have a cost of direct labor and also manufacturing overhead. And you will get the total manufacturing cost, right? And you will adjust the opening work in process and closing work in process. In this example, it is 0. Then you will get the cost of goods manufactured. And cost of goods manufactured, you will adjust for again opening finished goods and closing finished goods. Then you will get cost of goods sold. So always opening inventory we will add, and finished goods inventory or closing inventory, whether it is finished goods or work in progress or raw material, that we will reduce, and this way you will get what will be the cost of goods sold. So all these informations we are taking from our budgets, right? Then you will have other budgets like selling and marketing budget, general and administrative budget, how much salary you have to pay for accountant, for example, research and development budget. These are all not related to your production. So any budget for other type of revenue or expenses, that will come uh, under the extra budgets what we discussed here. So we can see here selling expenses, again facility and general operation expenses. So all the expenses, it can be sales commission, It can be license fees for the use of names and logos. It can be sales salaries, advertising, and clerical wages. These are all not related to your production. This is called as selling, general, and administrative expenses, SG&A. And certain expenses, again, it can be for unit level, like sales commission. What you are going to pay is for every unit. Maybe some are based on customer level, like licensing fees for the use of names and logos. So this way you will prepare your selling, general, and administrative budget. So once you have all these things, you have your sales budget and you prepared your cost of goods sold budget that we have seen in the previous slide. So you will get the total gross margin. And now from here, in the previous slide, we got 75,000 as our selling and administrative budget. And maybe we have like 2% of sales we are expecting it won't be collected. So that's a bad debt expense, for example 12,000, and you have to pay some interest for the loan what you have. That's an expense. So total expenses is going to be 93,250, and you got your net income. So this is what your budgeted income statement is. So all the information here is coming from the budgets what we prepared earlier. And finally, you prepared a complete income statement for the coming period. So what we prepared till now is operating budget. So operating budget is the budgeted income statement and its supporting budget schedules. So we now have a budgeted income statement, and also we have the supporting schedules, how we are going to get this income statement that we know clearly. And it is made up of all the revenue budget and the production, purchasing, marketing, research and development, all the budgets we consider, and we got income statement. Then we will have to prepare financial budget. This is the budgeted balance sheet and statement of cash flows. So we have discussed about financial budget in the previous slides. So yeah, now you have to prepare a statement of cash flow or cash budget and capital budget. These budgets are what the company's financial statement will look like next year if reality exactly matched the budgeted amount. So how your financial statement will look like in the coming year. Next year, how your financial statements going to look like, that is what you are going to prepare now. If every estimation you have done while preparing these budgets are accurate, then this is how your financial statement is going to look like. Okay, so this is what financial budget is. In this, we will prepare mainly cash budget. A cash budget is a financial plan that forecasts cash inflows and outflows. So over a period of time, how much cash is coming in, how much cash is going out, and what is the balance. That is what you are going to get in a cash budget. So it will help a business to manage liquidity and make informed financial decisions. So if you know I am going to have a surplus cash after 6 months of 1 million, then I can plan now itself what I am going to do with this 1 million. Or if you know I'm going to have a shortage of 1 million after 6 months, again I can do a plan how I'm going to manage the deficit in the fund. For that, we have to prepare a cash budget. So what are the factors considered in the cash budget? How much sales you are going to make and how much cash is going to come in, and how is your credit policies, what is the production cost is going to be, how much you are going to pay for it, what are the other operating expenses, and what investment activities you may be doing during the period, and what are the financing needs that you have to make sure, financing need to ensure adequate cash flow for what? For ongoing operation. So you may be having some operation that is going to have in the future, and how much you are going to have fund against these operations. And maybe you have some strategical initiative, you are going to launch a new product, or maybe you are going to develop to a new geographical area. So how much cash you need for all these things? So based on this cash budget, you can make a better decision in terms of all these things. Also, we have to consider the credit policies and your purchasing policies when you are preparing a cash budget. When you have tight credit policies, you are not going to allow a lot of your customers to keep your money pending without paying for a long time. You are very rigid on it, we are tight. So you are going to get your money faster. Same like stringent payable policies may delay supplier payment. Like you are not paying quickly to your suppliers. That will also conserve some cash. So both policies affect the timing and amount of cash inflows and outflows. And this is going to directly influence the cash budget. So are you relaxed with your customers? Then customer will pay slowly. Or are you keeping a tight credit policy? If the sale is going to be above, say, $10,000, if they don't pay, you are going to stop sale. So they have to pay first, then take the goods. So this is how you will prepare a cash budget. And this is the last budget prepared. So you will have your sales for the first year, and from this amount, how much you are going to collect during the period. And how much you have collected from the previous period. Based on that, by end of first quarter, I will have 187,200. So it is better you can check a period in the middle. For example, you will take second quarter, my sale is revenue is going to be 60,000, but I am going to collect only 48,000. How? We can see here, when I have sales of 60,000, I will collect only 80% in the same period. That is based on the credit policy you have with your customers. So that means that is going to be 48,000. So you collected only 48,000. And from the previous period, like 118,000, 20,000, 20% is left, right, from the last period, because 80% will be collected in the same period, 20% will be collected in the next period. In that, you will be collecting only 18%. Why? 2% is going to be your bad debt. So 18% of 180,000 you will collect in the second quarter, but this amount is coming from the previous quarter. So this is the collection that you are going to uh, and this amount is pertaining to the last quarter. So total collection is going to be 80,400. So this way you will calculate how much you are going to collect. Then you will see how much you are going to pay. Again, we have our cost of raw material, right? That we calculated already. So that we will consider. And cash payments for purchase made during the quarter, like maybe this amount you are paying for the last period. So again, we can go and check in the second quarter. The second quarter, what is the purchase going to happen? 18,150. But you will pay only 60% of that. So your purchase is 18,150, but you will pay only 60%, that is going to be 10,890. But again, you have to pay 15,780, that is belongs to last period, because every quarter you will pay 60% of that. 40% you will be paying later, the next quarter. So for the last quarter, I have to pay in this quarter. So 15,780 I have to pay in this quarter. Sorry. So total cash payment for direct material purchase is 26,650, and you have like other cash disbursement, and second quarter you will be paying actually 77,420, and that is going to repeat for all the period, and you will see I will have to pay 465,000 payment during the year, and I'll be collecting 588,000 for the period. Okay, so combining both this, we will have a total uh, cash disbursement or cash, sorry, we will have a total cash budget. So first is cash disbursement, sorry, first is cash receipt budget, then cash disbursement budget, and considering all that, you will have how much cash you are going to have by end of the period. So cash receipt is 187,000 less disbursement that we already calculated. So this is going to be the cash balance uh, during quarter due to operation. So this is the cash flow from the operation. Then you took a loan from bank and you paid for a construction. You repaid a loan. You paid for interest, and this is going to be the net balance what you have, or this is the change in cash balance for the period, and you were having 10,000 in the beginning, so total cash you will have at the end of the period is going to be 93,540, and this is going to repeat for all the period, and by end of the period I will have a cash of 26,750 as per my cash budget. And based on all these things, we can prepare a budgeted balance sheet. So we have our cash budget we got from here. We will have our account receivable, that's also based on the budget, and we have raw materials, finished goods, supplies, total inventory, this is coming out of our budget, and maybe other long lived asset like building equipment. And finally you will have your total assets, and same way you can have your total liabilities also. So everything is related. So this accounts payable is related to your purchase budget, and this is your total current liabilities, and again you have long-term liability, notes payable, this is all assumed amount, and you have 609,650 as your equity and liability. Okay, so this is how we will prepare a complete budget. Yeah, before that we have capital budget also. This is the budget for large capital expenditures like property, plant and equipment. If you want to buy a property, plant and equipment that is going to serve your company for coming 10 years, for example, for that you have to prepare a capital budget. And this is completely covered in part 2 actually in full details. So here you just have to know the basics of capital budget. And because these are large expenditures, the capital budget is prepared years in advance. So normally capital budget will be prepared many years in advance, because this involves huge investment. and company will need to plan for the financing of these purchases. And this budget is often prepared outside of the budgeting process that will have discussed leading to the forecasted financial statement. So this can be prepared outside of the budgeting process, and top level management is heavily involved in preparing the capital budget. So that's it for this presentation. We will stop this video now, and we are going to discuss about flexible budgeting in the coming presentation. So this will end up how you will prepare the complete budget. Okay, so thanks a lot for watching, and I will reach you in the second video of this budget methodologies. And thanks a lot for watching. Thank you for being with me. Bye bye.